Imagine you're 35 years old. You've got $50,000 sitting in your brokerage account. You've been reading about dividend investing, and you're staring at two different stocks on your screen. Stock A is yielding 7.2% right now. That's $3,600 a year in dividends from your investment. You could literally see that money hitting your account every quarter. Stock B, it's only yielding 1.8%. That's a measly $900 a year. Every part of your brain is screaming to buy stock A, right? I mean, who wouldn't want 4 times the income? Here's the thing, though, and this is what kept me up at night for weeks when I first started understanding this. That decision you're about to make could cost you hundreds of thousands of dollars over the next 20 years. And the math behind why is so counterintuitive that even seasoned investors get this wrong. My name is John, and I spend way too much time thinking about dividend growth investing and why most people completely misunderstand how wealth is actually built through dividends. If you're someone who's been told to just buy high-yield dividend stocks, or you're confused about whether you should be chasing yield or focusing on dividend growth, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we're going to break down the single most important concept in dividend investing that almost nobody talks about, and I'm going to show you the actual math that explains why the stocks paying you the least money today might make you the richest tomorrow. Look, I get it. When you're starting out with dividend investing, the logic seems completely obvious. Higher yield equals more money. It's basic math, right? You invest $10,000 into a stock yielding 6%, you get $600 a year. You invest that same $10,000 into a stock yielding 2%, you get $200 a year. The first stock is literally paying you 3 times as much money. Case closed. Except here's what most people don't realize. That 6% yield? It's probably not going to be 6% in 5 years. In fact, there's a decent chance it might not exist at all. A study from Hartford Funds analyzed dividend-paying stocks from 1972 to 2020, that's almost 50 years of data, and found that stocks with the highest dividend yields actually underperform the market by an average of 2.3% per year. Meanwhile, dividend growth stocks, the ones that consistently raise their dividends year after year, even if they started with lower yields, outperformed the market by 1.6% annually. Now you might be thinking, okay, John, but 3.9% difference? That doesn't sound like that big of a deal. Oh, but it is. Let me show you exactly how big of a deal this is. Let's say you invest $100,000 today. We're going to compare two scenarios over 25 years. Scenario A. You chase high yield. You find stocks averaging 6% yield, but because these companies aren't growing much, your dividend only increases by about 2% per year on average, and the stock price barely moves. Let's say 3% annual price appreciation. Scenario B. You focus on dividend growth. You buy stocks yielding just 2.5% today, but these companies are growing their dividends by 8% per year, and the stock price reflects that growth with 9% annual appreciation. After 25 years, here's what happens. Scenario A. The high yield approach. Your portfolio value, approximately $209,000. Your annual dividend income, about $9,800. Total dividends collected over 25 years, roughly $187,000. Scenario B. The dividend growth approach. Your portfolio value, approximately $862,000. Your annual dividend income, about $44,000. Total dividends collected over 25 years, roughly $312,000. Wait, what? The stock that started paying you less is now paying you 4.5 times more per year? And your portfolio is worth over 4 times as much? Yes. And this is where it gets really interesting because this isn't some theoretical scenario I made up. This is basically what happened if you bought Coca-Cola versus a high-yield utility stock in 1998. Here's the thing. Nobody tells you about dividend investing. It requires a complete psychological shift in how you think about income. We're hardwired to want immediate gratification. We want to see money coming in now. It's the same reason why people prefer getting paid weekly instead of monthly, even though monthly would be more efficient. Our brains value present rewards over future rewards, even when the future rewards are mathematically superior. And this is why high-yield dividend traps work so well. They exploit this cognitive bias. When you see a stock yielding 8%, you're getting dopamine hits every quarter when those dividends land in your account. You feel smart. You feel like your money is working for you. Meanwhile, your neighbor's dividend growth stocks are only yielding 2%, and you're thinking, I'm getting 4 times what they're getting. But here's what's actually happening. Your neighbor's company is reinvesting more of its profits into growth. It's expanding into new markets, developing better products, increasing its pricing power. And every year, it's raising that dividend by 7%, 8%, maybe even 10%. Your company? It's paying out almost everything it earns just to maintain that high yield. There's nothing left for growth. It's barely keeping up with inflation. 5 years from now, your high-yield stock is still paying roughly the same amount. Your neighbor's stock? The yield on their original investment is now higher than yours, and it's accelerating away from you every single year. Look, I need you to understand something about dividend growth that most people completely miss. It compounds in 2 directions simultaneously. First, there's the obvious compounding. Your dividend increases 8% per year. Year 1, you're getting $1,000. Year 2, $1,080. Year 3, $1,166. By year 10, you're getting $2,159. By year 20, $4,261. By year 30, $10,063 from the same initial investment. But here's the second layer of compounding that nobody talks about. If you're reinvesting those dividends, you're buying more shares. And those new shares are also growing their dividends at 8% per year. Let me break down a real example. Let's say you invest $50,000 in a dividend growth stock, yielding 2.5% with an 8% annual dividend growth rate, and you reinvest all dividends. After 10 years, you're collecting about $3,200 in annual dividends, but your yield on your original investment is now 6.4%. After 20 years, you're collecting about $14,700 in annual dividends. Your yield on cost is now 29.4%. After 30 years, you're collecting approximately $55,000 in annual dividends. Your yield on cost is now 110%. You read that right. Your investment is paying you more in dividends each year than you originally invested, every single year. And that's without the stock price appreciating at all, which it almost certainly would. Now you might be thinking, okay, John, but what companies actually do this? This sounds like a fantasy. Let me give you some concrete examples, and these are just using publicly available data. Johnson & Johnson. If you bought shares in 1984 when they were yielding about 2.8% and you held through 2024, your yield on cost today would be approximately 47%. They've raised their dividend for 62 consecutive years. Procter & Gamble. Bought in 1990 at a 2.1% yield, your yield on cost today is roughly 38%. They've raised their dividend for 68 straight years. Walmart. Purchased in 1995 at a yield of about 0.5%. Your yield on cost is now somewhere around 15%, and your initial investment has grown more than 40-fold when you include reinvested dividends. These aren't cherry-picked examples of the absolute best performers. These are boring, stable companies that just consistently did one thing: grew their dividends year after year after year. Compare that to high-yield darlings from the same era. Remember Frontier? Remember Communications? It was a high-yield favorite in the 2000s, often yielding 8 to 10%. The company cut its dividend in 2017 and eventually filed for bankruptcy. Shareholders lost almost everything. CenturyLink, another high-yield telecom favorite, cut its dividend by 54% in 2019. The stock lost over 70% of its value. Here's what most people don't realize. High yields are often high for a reason. The market is telling you something. Either the company is in a declining industry, it's over-leveraged, or there's serious concern about the sustainability of that dividend. Look, this is where we need to get real about how to identify actual dividend growth companies versus value traps pretending to be dividend investments. I'm looking at 3 key metrics, and these aren't complicated. First, the payout ratio. This tells you what percentage of earnings the company is paying out as dividends. If a company is paying out 80 to 90% of its earnings, red flag. There's no room for growth. There's barely room for error. One bad quarter and that dividend is at risk. I want to see payout ratios between 35% and 65% for most companies. That means they're returning value to shareholders, but they're also retaining enough to invest in growth. Second, the dividend growth rate history. I'm not just looking for companies that have raised dividends. I want to see consistent, meaningful increases over at least 10 years, preferably 20 or more. I'm talking about average annual growth of 7 to 10% or higher. Third, and this is crucial, free cash flow growth. The dividend ultimately comes from free cash flow. If free cash flow per share is growing at 8% annually, the company can sustain an 8% dividend growth rate. If free cash flow is stagnant or declining, that dividend growth rate is living on borrowed time. And here's something that took me way too long to understand. You want companies with pricing power. What does that mean? It means when their costs go up, they can raise prices without losing customers. Think about Coca-Cola. Think about Visa. Think about Costco. When inflation hits, these companies can pass those costs along, which protects their margins, which protects their dividend growth. Compare that to a commodity business or a highly competitive industry with no differentiation. When their costs go up, they can't raise prices because customers will just go elsewhere. Margins get compressed. The dividend becomes unsustainable. All right, so here's the actual strategy that makes sense if you're serious about building wealth through dividend growth investing. Step 1. Forget about current yield as your primary metric. I know this feels wrong. Your brain wants that immediate gratification. Resist it. Instead, focus on finding companies with these characteristics. Payout ratios between 35 to 65%, dividend growth history of 10 plus years, averaging 7% or higher annually, free cash flow per share growing consistently, strong competitive advantages or pricing power, operating in industries with long-term growth potential. Step 2. Look at your time horizon. If you need income today, like you're already retired and living off your investments, then yes, you need some current yield. But even then, I'd argue you want a mix. Maybe 60% dividend growth stocks and 40% higher yielding stable companies. But if you're in your 30s, 40s, or even 50s and you're building toward retirement, you want to be almost entirely in dividend growth. The math is just too compelling to ignore. Step 3. Reinvest those dividends religiously. This is non-negotiable if you want to maximize the compounding effect. Set up automatic dividend reinvestment and don't touch it. Here's what this looks like in practice. Let's say you're 35 and you start with $25,000 and you add $500 per month to your dividend growth portfolio. Your average starting yield is 2.5% and your average dividend growth rate is 8% per year. By age 50, 15 years, portfolio value? Approximately $185,000. Annual dividend income? About $9,200. Yield on new contributions? Still 2.5%, but yield on early contributions is now 7.9%. By age 60, 25 years. Portfolio value? Approximately $485,000. Annual dividend income? About $39,000. Yield on earliest contributions? Now 18.7%. By age 70, 35 years. Portfolio value? Approximately $150,000. Annual dividend income? About $115,000. Yield on earliest contributions? Now 44.3%. You're generating more in dividend income than most people's salaries, from investments that started with yields most people would laugh at. Now you might be thinking, okay, John, but what about the risk? What if these dividend growth companies cut their dividends? Fair question. And yes, it can happen. Even the best companies sometimes face situations where they need to preserve cash. We saw this during COVID when Disney suspended its dividend temporarily. But here's the thing. Companies with long histories of dividend growth are actually less likely to cut dividends than high-yield companies. The data on this is pretty clear. According to research from Ned Davis Research covering 1972 to 2022, dividend growers and initiators had an annualized return of 10.2%, while high-yield stocks returned just 7.1%. And that doesn't even account for the dividend cuts that absolutely devastated portfolios during that period. You might also be thinking, but what if I need income now? What if I can't wait 20 years? Look, I get it. If you're 65 and retired, you have different needs than someone who's 35. But even in retirement, I'd argue you should have a meaningful allocation to dividend growth stocks, because inflation is real, and your income needs to grow over time. If you retire at 65, you might live another 30 years. If your dividend income is flat while inflation runs at 3% per year, your purchasing power gets cut in half over those 30 years. You need growth to combat that. Here's what I really want you to understand. Dividend growth investing isn't just about the money. It's about a fundamental shift in how you think about building wealth. Most people approach investing with a scarcity mindset. They want every dollar working for them right now. They're chasing the highest current yield, the hottest stock tip, the next big trade. But dividend growth investing requires abundance thinking. It requires you to plant seeds knowing that you won't see the full harvest for years, maybe decades. It requires patience in a world that's constantly screaming for your attention and promising quick riches. And honestly, that's why most people fail at this. It's not because the strategy doesn't work. The math works. The history works. The logic works. People fail because they can't handle watching their neighbor brag about his 8% yielding stock, while their 2% yielding stocks feel like they're barely doing anything. They fail because after 2 years of 8% dividend growth, they still haven't caught up to the high yielders, and they lose faith. They fail because our entire financial media ecosystem is built around excitement and activity, and dividend growth investing is boring as hell for the first decade. But here's what happens if you stick with it. One day, you wake up and realize your dividend income is covering your mortgage. Then it's covering your mortgage and car payment. Then it's covering all your basic living expenses. And then, and this is the really magical part, you realize you're financially independent, not because you saved some massive amount of money, but because you bought great businesses and let them grow for long enough. All right, so here's exactly what I want you to do after watching this video. First, if you currently own high-yield stocks, I want you to do honest analysis. Look at their dividend history over the past 10 years. Has the dividend grown meaningfully? Is the payout ratio sustainable? Does the company have pricing power and competitive advantages? If the answer to any of those questions is no, you might be sitting on a value trap, and it's worth considering whether you should reallocate to actual dividend growth companies. Second, start building a watch list of dividend growth companies. Look for dividend aristocrats. Companies that have raised dividends for 25-plus consecutive years. Look for dividend kings, 50-plus consecutive years of increases. These aren't hard to find. A simple Google search for dividend aristocrats list will give you a starting point. Then research these companies. Understand their businesses. Look at their financials. Third, set up a systematic investment plan. Whether it's $100 a month or $1,000 a month, commit to consistently buying shares of quality dividend growth companies and reinvesting those dividends. Fourth, and this might be the most important, commit to a time horizon. Write it down. I will not touch this dividend growth portfolio for years. Fill in that blank. With a number that's at least 10, preferably 20 or more. Put that piece of paper somewhere you'll see it when you're tempted to sell because some talking head on TV is predicting a crash, or because your high-yield loving friend is mocking your measly 2.5% yield. Look, here's the truth. Dividend growth investing isn't sexy. It's not going to make you rich overnight. You're not going to have exciting stories to tell at parties about the 10-bagger you bought last month. But you know what you will have? You'll have a portfolio that pays you more money every single year. You'll have companies that are quietly compounding wealth on your behalf while you sleep, while you work, while you live your life. You'll have the peace of mind that comes from owning businesses that have survived recessions, market crashes, wars, pandemics, and every other crisis thrown at them over decades. And they just kept raising their dividends anyway. And most importantly, you'll have a path to financial independence that doesn't require you to time the market, pick the next Apple, or get lucky with crypto. It just requires patience, discipline, and a willingness to think differently than the crowd chasing high yields today who will be watching you collect massive dividend checks 20 years from now. The question isn't whether dividend growth investing works. The math proves it works. The history proves it works. The logic proves it works. The question is, are you willing to think long-term in a short-term world? If you got value from this video, make sure you hit that subscribe button because we're going deep on financial independence strategies that actually work. Drop a comment below and let me know. What's your biggest challenge with dividend investing? Are you team high yield or team dividend growth? And remember, the best time to start building a dividend growth portfolio was 20 years ago. The second best time is today. I'll see you in the next one.